Hi, everyone. Welcome to today's presentation. It's the Tools for Success, Women in Wealth on Investing in Your Future 101. Thank you for joining us live today. My name is Keeley Simpson, and I'm a portfolio manager and senior wealth advisor at BMO Private Wealth. Just walk you guys through, I'll bring you guys back to the quote there, but I'll just lay out some of the agenda for you. But before we begin, just a little bit about myself. So my name is Keeley. I graduated from McGill back in 2009, which is why I hold the title of Senior Wealth Advisor. It's really making me feel like I'm getting older these days. And I have 4 kids and 2 dogs, and we live in Toronto, Ontario. We do have a busy house. My oldest son just turned 5 years old in December, and my youngest is turning a year-old at the end of the month. So at this time last year when I did the webinar series, I was just a few weeks away from giving birth to her. So a lot has changed in a year. So thank you for joining today. Today is really just an introduction to planning and investing. So I'm gonna walk you guys through the presentation. And if you have any questions, please go ahead and ask them in the chat box. Although I can't see you, I just want to try and make this as interactive as possible for you to kind of answer any burning questions you might have going on right now. So money is genderless, but investing for women is different. Women tend to be, just historically, tend to be a little bit less confident in their knowledge about finances than men. And this uncertainty does tend to extend into retirement and financial planning. So we know also, just based on research, that knowledge leads to hands-on involvement in your finances. So the more that we can educate women about why maybe investing for women is different, why retirement planning for women can be different than for men, I think the better off we can all be. So the next slide is just, it's a quote. It's just about planning is bringing the future into the present so that you can do something about it now. So whether you're just starting off in your career and you just graduated from McGill, or you're a few years into your career and you're just wondering, you know, how do I set myself up to be successful down the road with my savings? You're here for the right reasons, and I'm hopefully you'll have a couple of aha moments today, and hopefully walk away with some nuggets of information that you can apply to your day-to-day finances, and hopefully plan ahead for your future so that when you do go to retire, or you do go to buy a house or a condo or even a second property, that you'll have a bit more knowledge about how you can get there. So the agenda today is we're going to start off with a quiz. We're going to talk about why investing for women is different than for men. We're going to talk about some of those unique challenges that women face in planning for retirement. We're going to talk about the basic steps to building your net worth. So if you have a piece of paper and a pen handy, that might help you just scribble down some of your information as we walk through it so that you can review it after. We're going to talk about selecting an advisor that can help you, on the pathway that you're on. I do have a survey at the end, which is actually a QR code, which is really cool, and I'm really excited to show you guys that at the end, where you can basically just point your camera to the screen, and it's going to just bring you to a website where you can fill in your information if you'd like to receive any of the resources that I'm going to be talking to you about today. So let's get going. So just in terms of the quiz, so what are your goals and what are you doing right now to reach them? So do you know how much of your monthly income you're currently saving? And like what the gross percentage would be versus the net percentage? And then in order to maintain your lifestyle after retirement, do you know how much capital you'll need to have saved to make sure that you'll be okay on a month-to-month basis. Do you know what all of your eventual sources of retirement income are going to be? How much is each one going to provide you with? And then what was the return on your investments last year? If you do have investments, what was the return on your investments last year and or savings? Obviously, last year wasn't a great year for the markets, and we're going to talk about that today. But just to have an idea in your mind about what that was for you. So 78% of high net worth women work with an advisor right now, but 1/3 of them don't enjoy investing because it's just not speaking to their life goals. Women have in the past been socially conditioned to believe that finance or money is just not their area of competence, but frankly, in my opinion, they know way more than they give themselves credit for. How women relate to money is different than men. Women do tend to be a bit more emotional about it and concerned about the life choices, whereas men want to know what the big pile is. And actually, I have a funny story about that. I was asked to complete a survey recently, and one of the questions was around how women, like how female clients over the past year have reacted to the volatility in the markets that we've seen. And my response was that I didn't feel it was a great gender specific question because just with the clients that we have in our practice, we've seen men actually have reacted the most to the volatility, going back to they want to know how big that pile is, how the net new number is, right? I know I mentioned that I work here in Toronto, Ontario, but I've also been with BMO Private Wealth now for over 15 years, and I work with my business partner. His name is Lee Rohrbeck, and so Lee and I have been working together for a long time, and we manage about 215 client relationships. On average, those clients have about $3 million with us. And so when I was asked that question about how women have reacted to the volatility, I was like, it's actually the opposite. It's men who have reacted more so in the past 18 months to the volatility that we've been experiencing, more so than women. So women do seek to feel secure, connected, and fulfilled when it comes to their finances, which again goes back to what the big pile is versus knowing that they're investing for their life goals. One of the questions that's coming up right now is what is considered a high net worth woman? I'm not sure what the actual dollar figure is, but I think it's if you have investable assets of more than $1 million, that would be considered a high net worth person. And I think ultra high net worth would be 3 to 5 million, I'm pretty sure, but it's usually over $1 million would be considered, I think, a high net worth woman. So some of the unique challenges that women face in planning for retirement are that it is typically presented as a couple experience. And so that's not necessarily always the case. Sometimes there's divorce. Sometimes, women are not getting married today the way that it was many years ago. Or women are outliving their spouses. So really having it presented as a couple experience, that's one of sort of the unique challenges that we see. Women can have a smaller nest egg just because if you've left the workforce for some period of time to take care of children or take care of your parents, those are historically speaking, the responsibilities that have sort of fallen on the women. So that's one thing that can happen. Women are living longer than they were before, and they're also living longer than men, which has always been the case. That confidence piece in investing that we talked about. Some of the non-financial aspects of retirement that women do come out ahead, and that's really because women tend to put more priority on their relationships and they don't identify with the work that they're doing day to day, whereas men tend to put more of a priority on their identity when it comes to their day-to-day work. So because of that, men and women do tend to complement each other when it does come to retirement planning. So this is one of the resources that I have that I can send out to you if you're interested. So when you do complete that survey, this is called the Retirement Expense Worksheet. So it's great because it's fillable. So you can put in what your mortgage or your rent is, condo fees, repairs, basically all of your monthly living expenses. You can put in fixed or discretionary. So if it's fixed, it means that you have to pay for it every single month. And then discretionary would be like, you know, a vacation or going to Starbucks. For some people, they consider that a fixed expense, but if you were trying to save money, maybe it could be a discretionary expense, I'm not sure. But then what you do is you put in your current age, and then you can basically have it project out to the age of your retirement to show you how much that will be based on inflation, which we're going to talk about as well. So what does retirement look like to you? Today is really kind of a basic investing and planning webinar. There is a session next week that's much more geared towards retirement planning, so I'm not going to touch upon this too much today, but basically, again, women living longer, it's no longer a set point in time. Women are taking care of their children and their parents at the same time, sometimes even grandparents. Company pensions are more of a thing of the past. Now it's more defined defined benefit plans, defined contribution plans. The onus is more on the employee to do the saving than on the company to match the highest earnings within a certain period of time. And then a lot of people are retiring with debt now. And a few years ago, that wasn't such a big deal because interest rates were so low. But now interest rates have become higher than they were. Still not like they're higher because we're used to such low interest rates, but historically speaking, like not that high. But retiring with debt now can mean that your debt payments, service payments, would be higher than say a few years ago with interest rates much lower. So some of the traditional rules of thumb are: I'm fine. I have a company pension plan, so a retirement myth. I need 70 to 80% of my pre-retirement income. I've heard I need $1 million to save. I need to save $1 million. I will be fine if I only withdraw 4 to 5% a year from my savings once I retire. So one rule of thumb that I do really like is withdrawing 4 or 5% a year from your savings. So if you're trying to figure out, how much you need to live off of when you retire, then you would just basically figure out what your monthly budget is, and then figure out how much you would need to save in order to draw from that nest egg on a monthly amount. And so as long as your rate of returns are higher than that 4 to 5%, the savings should last you, quite a bit of time. Obviously, if we have periods of negative returns in the markets and inflation right now is historically higher than it has been, that obviously puts a wrinkle in some of those historical planning numbers, but that's kind of like a good one to work off of. So again, I feel like I'm repeating myself, but women are now taking care of their parents, may leave the workforce, adult children returning home, caring for grandchildren so that their parents can work, outliving spouse, divorce. Some of the legacy questions are, working longer, how much and in what capacity. And one of the biggest themes that we've seen come out of the pandemic has that it has set women back more than men in their careers. And that's really because of the responsibilities that women tend to take on in the household versus their male counterparts. So that all of the statistics are showing, all of the research, that it's set women back in their careers by a few years, which again will have an impact on how much you can save for your retirement, and so on and so forth. So it has a domino effect. So let's get into the basic steps to building your net worth to keep on track here. So if you have any questions, please go ahead and ask them, and we can answer those for you. So the basic steps to building your net worth are to have a plan. So to have a plan, the best thing is to create a balance sheet. So how much do you spend and how much is left over every month? And then creating a statement of net worth. So again, if you just have a pen and a paper handy, you can just maybe write this out for yourself. So your assets are basically what you own minus your liabilities, what you owe against that asset. So if your house was worth $300,000 and you had a mortgage on there of $100,000, then there would be a net amount there of $200,000, and that's really like your fixed asset. And then if you have any financial assets, so any savings accounts, RRSPs, TFSA, any non-registered funds, that would be go in your financial assets column. So then you would kind of add those two together, and that would determine what your net number is in terms of your net worth. So creating a balance sheet, so spending versus how much is left over for saving. Creating a statement of net worth, so assets minus liabilities, and then paying yourself first. So how much can you save and how much should you save to reach your goal, if retirement is what your goal is. So you want to save the budget, again, the expense worksheet, if you're interested in that, please let us know and we can get that off to you. Generally speaking, you want to have an emergency fund, and that emergency fund, depending on how long it would take you to find another job, would be based, maybe a few months of net income if that's possible for you. A registered retirement savings plan is another option that you can save into, and then a tax-free savings account is an account that grows tax-free over time, and then having a reinvestment program. So whether that's with what you're buying inside of those accounts, so if you're buying stocks or exchange-traded funds, have a DRIP program on them that basically is a dividend reinvestment program, and it will reinvest and buy more shares of those companies or positions automatically when dividends are paid. So that way you have a reinvestment program. Over here, you want to set your objectives. So we talked about having a plan, and now we're going to help you set what your objectives are. So what are your goals? Is it major purchase? Is it retirement? Is it saving for children's education? Is it estate planning? Do you have proceeds of insurance? Is it gift planning, legacy planning? Those are kind of some of the goals that we see most often. And then developing a retirement plan. So having really like the 3 sources of retirement income, which was one of the questions that I asked before. So the 3 sources of retirement income are government plans, and then you have company pension plans and personal savings. So let's talk about the government plans for a few minutes. So if you're currently working and you see on your paycheck that you're contributing towards the QPP if you're in Quebec, or the CPP if you're in other provinces. And then the company pension plan would be if you work for a company that maybe has a matching plan that you can contribute into. If that's an option for you, I'd highly recommend just to try and maximize that as much as possible so that you can get the best possible matching for your dollars. And if you're just starting out with the company and they have an employee share ownership program available to employees, highly recommend that as well. A lot of companies will match up to a certain percentage of employee contributions. This is a great way to boost your savings. So when the company matches those contributions for you. Like if you need to be saving 15 or 20% of your income a year to reach those goals, and because of the company matching, it's really only, let's say, I don't know, 10% of savings because the company will match, then that's a really great way of like boosting up those numbers right off the bat. And especially if you're just starting out, even in an employee share ownership program, doesn't have to be within a registered savings plan. It could be within a tax-free savings plan sometimes too. And there is a lot of room out there right now. And I'll talk about the TFSA in a few minutes so that you can see what the numbers look like. But that's a really great way of paying yourself first and maximizing what's available to you is with your company pension plans or employee share ownership program. If you have personal savings, then you'll have money flowing out from your registered retirement savings plan and or your tax-free savings account and or your non-registered account. So replacing today's income. So I used a 5% inflation rate just to give you an idea of what 5% inflation actually means. So an apple today is not an apple tomorrow. And that's something that we've experienced, I guess, because of the pandemic and all of the supply chain issues that we've lived through now. So if your income today is $60,000, 20 years later, that's basically the equivalent of $159,000. So the inflation really kind of is important to consider when you're doing your planning. So some of the advantages of an RRSP is that the contributions that go into that plan are tax deductible. So they go against your earned income for the year. So if you just started working this year, is your first year working, and you had T4 income of, I don't know, $60,000, then I would go onto a tax calculator and see if it would make sense to contribute to an RRSP to reduce some of the taxes, some of that tax bill, because it goes directly against your registered retirement savings plan contribution, goes directly against your T4 income. And then the other advantage to an RRSP is that it's tax deferred compounding. So what that means is the money inside of that account grows tax-free, and the money inside of a tax-free savings account also grows tax-free. But the thing is that with an RRSP, it's actually tax deductible contributions. So it goes directly against your taxable income for the year. And by the way, for this year, you can still make a contribution. The deadline is on March 1st. So you still have a few weeks to make a contribution for your income that you would have earned in 2022. So some of the rules to live by, especially starting out, is starting now is better than nothing. So, you know, open if you have T4 income, it makes sense probably to open a registered retirement savings plan account. If it's possible for you from a budget perspective and a tax perspective, contribute your maximum. And again, if it makes sense, you want to contribute early on in the year each year or monthly, and that's because you want to take advantage of that tax deferred compounding. But if you're making contributions, like again for 2022, and you're making them in February before the March deadline, that's fine too. It's, you know, it's just that you do get tax deferred compounding. So if you have the funds available and you can make it work, monthly is actually a great option, because you set the amount that you want to come out of your bank account the moment that your pay comes in, and you just know that you're paying it into your registered retirement savings plan account. And then investing wisely. So what do you do with the money that goes into those accounts is important too. So over here I have the 2% difference. So if this is basically if you had put in $5,000 a year for 5 years, and you had a 6% rate of return, the account balance in year 5 would be $29,877. But if you had a 10% rate of return, it would be $33,575. Now, if you were doing this consistently for 35 years and you had a 6% rate of return, that was your consistent return, your investment balance would be $590,000. But at 8%, it would be $930,000, and at 10%, it would be $1.49 million. So it's really important to make sure that you're investing wisely. It's also important to know what your management fees are. If you're paying management fees, even if you're buying mutual funds do have management fees that are embedded in those products. And exchange traded funds do have very low management fees, but they do have management fees. So it's just important to know what that net number looks like. So the tax-free savings account was introduced back in 2008. This year is the first year in a few years that they've actually increased the contribution limit. So it's up to $6,500 for this year. Again, the investments grow tax-free, so the interest, dividends, gains. If you've never opened one and you turned 18 before 2009, you can actually contribute $88,000 today. And then some of the rules are that you can't over-contribute. The government will come back to you and ask you to pay a penalty for that. And it's really not a good idea to contribute, withdraw, and then contribute again in the same year, because that can impact the room and how the CRA views that. There's a question that came in here. So for Canadians living and earning income abroad, is it allowed to invest into an RSP, or does one need to be a resident to invest? I mean, if you're paying taxes in Canada, so I don't know specifically how, like if you're getting a T4 that's Canadian that goes to the CRA, the Canada Revenue Agency, and you're considered a Canadian earning income, like and you're taxed in Canada for that income, then I think it still makes sense to contribute to an RSP. But I would ask an accountant for advice on that, just because it is cross-border or international tax situation. But generally speaking, if you're a Canadian, getting Canadian income, paying taxes on your worldwide income in Canada, even if you are living somewhere else, then it probably still makes sense. But if you're in the UK and you get like you're getting access to like a UK pension and things like that, then it probably, even though you're Canadian, probably doesn't make sense to contribute to an RRSP, because you're paying for your income taxes in, say, the UK. But again, I would just speak to an accountant about that, because that is like an international cross-border type tax situation that I'm not 100% sure about. If you have any other questions, please keep asking them. I'm happy to answer them as I go through the presentation. So a TFSA versus an RSP. So I just thought I'd show you guys what the what the difference is between the two. So again, an RSP, the contributions, you're getting a lower taxable income. They both grow tax-free. But let's just look at scenario 1. So your marginal tax rate is 40% when you contributed to the RSP and the TFSA. You'll see that the net withdrawal, it's $8,756 in both cases. But because you had income tax payable on that TFSA contribution, the account balance, you know, it was $14,593 in the RSP versus $8,756 in the TFSA. In this particular case, I guess it didn't really make that much of a difference, except that the account balance was higher. So if you had a higher than 5% rate of return, it probably would have made a difference. Over here, if it's 40% when contributed and 20% when withdrawn, so when you're retired, generally speaking, the idea is that you're not really going to have, you know, a high income tax bracket. So if it's 20% when it's withdrawn, then you're getting more out of it to put money into the RSP versus the TFSA. And then the same is true the other way around. If you're only at a 20% marginal tax rate when you're contributing and 40% when it's withdrawn, then of course the opposite is true. The TFSA is much better. So a TFSA or an RRSP for children's tuition, which is better? So an RRSP is a registered education savings plan, and that is better than a TFSA. And that's because with an RRSP, the Canadian government gives you a grant every time you contribute to the RRSP. So if you contributed $2,500 for the one beneficiary in the account, they're going to match $500, and that account also grows tax-free. So in that particular case, an RRSP would be much better. Just looking at these questions here. So, oh, there we go. So what happens if you contribute to the TFSA and your investment loses money? Do you lose the contribution room? You don't lose the contribution room as long as you don't withdraw the money from the TFSA. Yeah, okay. There's more questions, sorry. Regarding the TFSA contribution, if I verify correctly, hang on. Yes, if you've never contributed to a tax-free savings account before, and you have $88,000 sitting in your bank account right now, and you turned 18 before 2009, you can use the full $88,000 and put it into your tax-free savings account today. I would double check to know what your contribution room is, just to be sure. I would go on the CRA website where you can see where your RRSP contribution room is, and then it also gives you what your TFSA contribution room is. So just to be sure. It's not necessarily ever too late to contribute to an RRSP. That was another question that came out. It's never really too late to contribute to an RRSP until you turn 72, when you have to turn it into a registered income fund. But you want to make sure that it makes sense, because an RRSP, it's going against your taxable income. And then, you know, you want to basically make sure that from a tax perspective, the amount that you're contributing into the RRSP is going to reduce your taxes on your income tax bill, if that makes sense. Wow, we're getting really excited about these questions here. Okay. What is income tax payable as the TF and TFSA indicating tax-free? Why is there tax involved? There's no tax involved in the tax-free savings account. There's no income tax payable when you withdraw from it. There's no income tax payable because it does grow tax-free. The income tax payable in my scenario here, it's relating specifically to the RRSP, because when you withdraw money from the RRSP, that has income taxes payable associated with it. Okay. Do you have to pay the grant from the government back if you have an RRSP? I'm not sure I understand the question, but you don't have to pay it back. Maybe if the kid doesn't go to school, maybe that's the question. So if the child doesn't end up going to school, there are a couple of options available to you. I believe that you can roll the net contributions into your own RRSP if you have room. There's a couple of options available there. So it's not that you have to necessarily pay it back, but if you have other children, you can do what's called a family RRSP plan. So if you had two children, for example, and then the one decided not to go, but the other one did, that other one can benefit from the family plan. So I think it still makes sense to have it. Okay, if I have contributed to an RRSP, but my child has not used the funds completely for school, how can I access these funds without being taxed to the point of losing the government grant portion? I'm not sure like what the amount of the grants were. I mean, I'm happy to take that question offline. You're welcome to send me an email and I can try to answer it a little bit better for you. But you know, an RRSP withdrawal can be used for tuition, books, rent, laptop, iPad, like all the technology too. If they really haven't used all of it and you want to basically withdraw the rest, it can also be withdrawn into the child's hands as an education assistant payment program and a plan. And then there's also another way to withdraw it into the child's hands so that you're not taxed on it. And then if you want, I believe you can roll it into your own RSP if you have room for it. Like there's a couple of different options available. So if you want, you can email me and I'll keep going through the presentation. So we've got a few more questions coming through here, which what I'm going to do is I'm going to keep going through the presentation just so that we don't miss out on the rest of the information. And I'm going to come back to these great questions in a few minutes. Okay. So some people always ask, is it better to retire now or retire in 2 years? So if you had a 6% rate of return and your annual withdrawal was $18,000, but you had a 6% rate of return and you worked 2 extra years, the money could last you 5 extra years. So that's just showing you kind of the power of that tax-free compounding option for you. So the next part is create and manage your investment program. So it's really good to look at what your needs and your objectives are individually. So take a few minutes just to think about your current financial picture, what your risk tolerance is, so how much risk can you handle in the portfolio, what your time horizon is, how much time you have until you're going to need those funds, what your knowledge is right now, what your time commitment is, and what your goals are. So the investment menu is short term, so less than a year. Then there's fixed income, which is made up primarily of bonds and preferred shares, which last year didn't do very well. And then there's common equity, so stocks. And also last year had a bit of a rough year. So we're just going to go through the options here. So there's treasury bills, which are generally risk-free. There's GICs, which again, pretty much risk-free. They pay interest and there are terms of 1 to 5 years. This is just to calculate your real rate of return, which would be what your rate of return is minus inflation. But because inflation is so high right now, we're just going to skip through that. So government bonds and corporate bonds, you have straight bonds, strip bonds, mortgage-backed securities. And then preferred shares, we have regular, they come through as paying regular dividends, which tend to be more tax effective than interest payments from bonds if you're investing in a non-registered account, so outside of an RSP or a TFSA or an RRSP. There's a credit rating that's associated with them, just like bonds. And again, historically, prices can be less volatile, but preferred shares actually have experienced quite a few different periods of volatility, and because they are primarily linked to interest rates, so they can be volatile as well. Common stock is when you have ownership in a publicly traded company. I always look to buy companies that pay dividends in case they have a period where they're not earning, or not earning, but they're not, the performance isn't as great, at least you're paid while you wait. And again, if you're investing outside of a registered plan, you have a dividend tax credit that you can benefit from those dividends. And then of course there's capital appreciation potential. And again, last year, I know it's not a great year for any of those asset classes except for GICs. So that's how that was last year. And I'll walk you guys through that as well. So asset mix is really a strategic blend of stocks, bonds, and cash. Why is it important? Well, it basically determines, it's a strong influence on your risk and reward trade-off. So how much volatility and how much reward you're getting for your investments. It's basically it's really like the most effective way of accommodating your unique investment preferences when it comes to investment management. So diversification in different companies or asset classes, it does reduce your risk. but too much diversification doesn't make sense either. So you kind of want to have a good balance. I usually say, like, if you're going to have a stock portfolio, you probably want to have like 35, 40, 45 names in the portfolio. You probably don't want to have too many more. But again, if it's a tax issue to sell some of those positions, or there could be a number of reasons why you would have more than that. Just over time, it probably makes sense to have, 35, 45 names kind of a thing, but not like too many. Whoops. Diversification, again, is by asset type, so stocks versus bonds, by industry, so technology, financials, industrials, and by country, so US, Canada, international. When is the right time to invest? Well, I don't have a crystal ball, but there are risks when it comes to market timing. At the same time, we've experienced a lot of volatility over the past year, so it's understandable that people can be a little bit nervous. But some of the risks of market timing are that you can miss some of those upswings that can happen really quickly. And then if you're investing in a non-registered account, you'll have taxable capital gains from that. I think it's really important also to buy value, buy dividend-paying companies so that you get paid while you wait. And then obviously the most important part of it is to take a long-term perspective on it. So this over here is just a snapshot of the performance benchmarks from the past 20 years. So last year, not a great year for really any of the stock markets, and bonds had experienced quite a negative year as well. But over time, you're seeing a much more positive number and much more positive trend. So last year was kind of an anomaly, and this year we're a little bit more positive on the markets in general as we work through some of the fallout from rising interest rates and a possible moderate recession. This is an article on the current market conditions that I have. Happy to send it out to you if you're interested. It's just a market summary on equity and fixed income investing. Just talks about basically what happened last year, where we see things going in the next 12 months, and what that means for your portfolio. So it's the equity and fixed income strategy if you are interested in reading that. And then selecting an advisor. So put your questions in the chat because I'm going to answer all of them over the next little bit. I'm just going to finish the presentation. There's only a couple more slides, and then I'm going to finish answering all these great questions that you guys have sent through the chat here. So selecting an advisor, it's a very personal decision. You want maybe to ask for recommendations from friends or family of who they're working with. I think maybe you want to interview some people, see if it's the right fit. You definitely want to understand what their cost structure is, so how they get paid, what the service expectations are. Are you going to hear from them once a year, twice a year? If you need something, are they going to be quick to get back to you? And what kind of services are going to be provided by that person for the management fees. So financial planning should be provided. There should be setting goals and objectives. The person should be able to provide you with investment research and advice, as well as the asset management, so portfolio management, progress reports, so monthly statements, portfolio reports, performance reports, have financial updates and portfolio reviews. How are you doing compared to what your plan should be? And again, what those service expectations are. So I'm going to start answering all your great questions. So some of the resources we talked about were the retirement expense worksheet, which is a fillable, it's a fillable sheet. I also have a checklist of 10 years or more to retirement. I have some other ones if you're closer to retirement. Just today is like a investing 101, planning 101 session. So I have 2 to 10 years, and then I think maybe 5 years. Anyway, if you need any of those checklists, please let me know. And then their equity and fixed income strategy research. So the survey, if you want, what you can do is you can take your phone. This is really cool. I'm really excited about it. Should be very user-friendly. And you just point your camera towards the screen and it'll pop up with the QR code will pop up with this website that you follow, forms.office.com. And then it's going to lead you into the survey where you can put your the information and then the any of the resources that you're looking for from today's presentation. Okay, so I'm going to answer your questions. All right, let me just load them up here. Okay, so the last one we talked about was the RRSP. Okay, so I was told during this market that it's better to pay down debt right now and pause RRSP contributions. I mean, yes, there's really kind of two ways to look at that, because if you have T4 income, then you're going to have a higher income tax bill if you don't contribute to your RRSP, if you're earning a higher or even just kind of any income. I think it's important to balance the two out. I know mortgage rates have gone up substantially over the past 12 months. So for sure, you know, having a debt, like reducing your debt, even interest rates for a personal line of credit, all that kind of stuff, I get it. But at the same time, you want to also balance out the money that you can get back from the government, because that you're kind of leaving that money on the table. So it's a personal preference, personal to your own income and what your tax situation is for the year. But if that's what you were told, then it probably makes sense based on your income. I am in my early 60s. I'm in my early 60s. So you've been away from Canada for the past 30 years and you're planning to return. Okay. I mean, not knowing where to start, I would ask if you have any family that's here in Canada, you know, who they're working with. I'd be happy to speak with you. Just give me a call or send me an email, and I can help see what we can help you and try to connect you with someone or see what we can do to get you. Since you're coming back to Canada, we can see, you know, how best to help you out there. Can I contribute to my RRSP, withdraw for a home buyer's plan, and contribute more money into the RRSP in the same year? So the home buyer's plan is very tricky because the money has to be in the plan for at least 90 days before you can withdraw it for the home buyer's plan. And there is a maximum amount for the home buyer's plan. I think it may have gone up. It was $25,000. I'm not sure if it's gone up more than that. But yes, you can put more money, you can contribute more into the RRSP, and also withdraw some of the money for the home buyer's plan. That is allowed. You just don't, like, if you've got the money in your RRSP, don't expect that you can just withdraw the entire amount if a portion of it hasn't been in your account for at least 90 days. If I am a student whose main source of income is scholarship money, would it make more sense to open a TFSA or an RRSP? I believe scholarship money, I'm not sure if it's tax-free income or taxed at a different rate, but given that, I would probably say it probably makes more sense to invest in a TFSA. Just depends what the tax situation is with scholarship money. If I contribute to my RRSP, does it count towards a home buyer's plan repayment, or is that considered separate? So it has to be considered separate when you file your income taxes. A portion of the amount of money that you've put back into your RRSP will get allocated towards that home buyer repayment plan, and then the balance of that will go towards your actual RRSP contribution for the year. This is very basic, but how do I open an RRSP account? Any bank? Do they give a receipt that then I submit with my taxes? Also curious if this is the same for the new first-time house buyers account. Thank you. So the new first-time buyers account is brand new, and I think most banks will have it available in the next couple of months by May. The RRSP account can be opened at any bank branch. You can also open it online. There's some online investment platforms like Wealthsimple, InvestorLine, which is BMO. You could open it online. And then, or you can go to the bank, whatever you're most comfortable with. And then the receipt gets mailed out to you shortly after you've made a contribution into that account. For those wanting to make environmentally responsible investments, what would you recommend? Are there plans specifically for environmentally responsible investments? And how profitable are they currently? Well, yes, they do tend to have a very good return because the companies tend to be very well managed when they're considered socially responsible investments. We have actually a whole portfolio that's a global sustainability portfolio, and there's also an index that it follows, and it's the I wish I had it in this presentation. I have it for next week because again, this was more of like a basic presentation, but they can actually be even better rated returns than non-socially responsible companies. So. And there is a global index that you can look at that follows all of those companies. Why isn't it good to have more than 40 in investments? I heard the more diverse, the better. Some ETFs have more than 1,000. I mean, it's a historical. It's just historically, it's better to have less, like obviously not only 10 positions. But it's just showing you that diversification over 1,000 different companies, it's basically just getting the market return. So you'd be going up with the market and down with the market in order for the portfolio to do better when the markets are down, or do better or have an even higher performance when the markets are up. You want to have a well-diversified, specific portfolio so that you can benefit from that active management, but otherwise you can just have the whole market, and that the whole market has even more than 1,000 companies between the US, Canada, international. Okay, how do we determine the net number? Is there any type of guideline depending on age and income? Well, the net number is just personal to you, and it's just whatever your assets minus your liabilities are. Plus any other assets that you have, that's what your net worth is right now. How much does it cost to have a financial advisor? I mean, it depends on who you're working with. Like I had said in one of my earlier slides, when you're interviewing for someone to work with, it's important to understand how they get paid. So just generally speaking, if you had, I don't know, $500,000 of investable assets, usually the management fee, it really depends. Could be 1%, could be 2%. It really depends who you're working with. It could be $5,000 a year, it could be $3,000 a year, it could be, you know, if you're going to work with like a wealth advisor or someone who's going to actively manage a portfolio for you, I think you can expect to pay probably at least $3,000 a year to work with a professional wealth advisor. Do different platforms, banks offer different interest rates for RSPs? Should I shop around? And once I open one, is that my account until I retire? You can have more than one RRSP account at different banks. You don't have to have just one, but the total amount that you contribute is that's what you have to pay attention to between the different accounts. Do different platforms offer different interest rates? I think they do. I think Tangerine has a really good deal right now for just like money sitting in the account. I think it really depends. You know, even GIC rates can differ. Like different banks are offering different GIC promotional rates as well. So if you're looking to get like a good interest rate on the cash position, then yes, I think it probably does make sense to shop around. You mentioned that a first step to find an advisor can be to ask for a referral from family, friends. Where else would you suggest to look? Just what you're doing today. I mean, today you joined a webinar to learn more about your finances. Happy to have a conversation with you, point you in a different direction. Many resources are available online as well. Just searching online as well for could work as well. So yeah. Once you have a TFSA account, can you move around where that account is located? Yes, you can move it around without penalty, generally speaking. But if it's at a brokerage, so like a RBC Dominion Securities or TD Dominion Securities, they would charge a transfer out fee for moving it to a different brokerage. How do you calculate your net worth when you're married? Divide in half or calculate the net worth for the household? You can do it either way. If it's for the household, then that's the total number. But if you're married, generally we divide it in half to know what your own number is versus the other person. Can you have more than one TFSA as well? Yes, as long as you're keeping track of how much you're contributing to a TFSA at XYZ location and to the TFSA at, I don't know, BMO versus RBC for the sake of keeping things simple. So yes, you can have more than one, but you have to track how much contribution you're making as a total amount. Okay, well, I'm glad I got through all those questions. Thank you for answering all of them. Thank you for joining us today. And again, if you have a few minutes, actually just 1 minute, you just can point your camera towards the survey on the QR code, and it will pop up with a website for you to fill it out. And I'll make sure to get back to you shortly. And thank you again to the McGill Women's Alumni Association for asking me to join you guys today. And I hope that you found this useful and informative. And I hope you can walk away with a couple of maybe aha moments or just more information than what you started with before we began. So again, my name is Keeley Simpson, and it was really great to have you guys all join today. And I thank you very much. Have a great day.